This video is on issuance of stock and methods of stock valuation. So what is methods of stock valuation? So we have many price for value of the stock. So methods of material pricings. Okay, we have three methods here. Okay, based on cost price is first in first out. Number two is last in first out. When we use average price, we use weighted average method. So it shows that, okay, let's say when you purchase the material, you purchase at a different time. So at a different time may have a different material price from the supplier. Let's say on 1st of January, you purchase 300 units at a price of RM 10 ringgit per unit. And then 10 days after that, you purchase again 10 of January, another 200 at RM. Okay, the price is increased. Okay, at this time the price is 11 ringgit per unit. So this is when you purchase. Okay, you purchase, and then this is your purchase. So on 12th of January, you want to issue to production to be used in the productions of the product. Okay, let's say you want to produce the product by using 200 units or 150 units of material that you need to take from the store. So when you want to get 150 units of stock, okay, so how much the stock should be charged? Either to charge 11 ringgit or 10 ringgit, because we have uh, two prices here that you purchase on 1st January, the price is 10 ringgit, and you purchase on 10th of January, the price is 11. So when you want to issue, at what price you want to issue? So we base on these three methods. Either first in, first out, that means we take the first price, or we take the last price, last in, first out, or we calculate the weighted average method. Okay, so what is first in, first out? The first method is first in, first out method. So we take the earliest, okay, the earliest material purchase are used first until finish. So that means we take the first price that we purchase. The issued material will be recorded using price for the first material purchase. So it have the lowest cost of goods sold. Cost of sold or cost of sales will be lowest. Why? Because when you issue at the, okay, when you issue at the first price, so that means you issue at the lower purchase price. Okay, if the price increasing, okay, first 10 ringgit, second 11 ringgit. So when you issue the first, you take the 10 ringgit, so you issue at the lower price. So when you issue at the lower price, what will happen? Okay, cost of sales. So cost of sales will be lowest. You take the lowest one. Okay, so issue at the 10 ringgit, the lowest, this is cost of sales. So at the end of the period, the closing stock is at the higher price. Okay, so that's why your profit is higher. Sales minus cost of sales. So cost of sales consists of opening stock plus purchase minus closing stock. So when your closing stock is higher, cost of sales will be lower, so the profit will be higher. So the profit will be higher. So this is first in, first out. So now, what is the advantages of first in, first out? So advantages, the first one, material issued at actual cost. So that means at the cost that you purchase. Stock is value is presented fairly at the current market value, because your stock is at the lowest price. So the lowest price is the latest price. So your stock is at the current market value. Avoid obsolescence of stocks. While the disadvantages of first in, first out is difficult to administer, you have to monitor the price, and then measure cost based on the oldest material price. So that means your cost of sales based on the first one. So the first one means the oldest material price. Okay, the second method is last in, first out. So the last in, first out means the last material purchased first to be utilized. So that means you take out the latest price. So the latest price, if example before 1st of January 10 ringgit, 10 of January is 11 ringgit. So when you want to issue, you issue the latest price. Okay. So the last material purchase at 11 ringgit. So stock is valued at cost but may be valued at outdated price. So cost stock value. So when you issue at the latest price, so your closing stock will be at the price, the price that you purchased earlier. So your closing stock may be outdated price because the price keep changing. Okay, it have high cost of sales that lead to lower profit. So as we said just now, sales minus cost of sales. So cost of sales consists of opening stock plus purchase minus closing stock. When your closing stock is at the lower, what will happen to your cost of sales? Cost of sales will be higher. So when cost of sales will be higher, okay, sales does not change, minus the higher cost of sales, the profit will be lower. Okay, the profit will be lower. So this in the case when your price keep increasing. Okay. Advantages of last in first out, product is more realistic. Okay, product is more realistic because you issue at the current market value. Okay, based on accrual concept, but disadvantages, administratively complicated. You have to monitor, okay, the different price of stock. Closing stock will be valued at out of date price because you take the first price coming in, because this is balance in the store. The latest price is issued to the production. Induced obsolescence. Okay, the third method will be weighted average method. So weighted average method is the average cost of all units in the stock is computed after every purchase. So when you have to purchase transaction, you have to calculate the average cost. So the total cost minus divide by number of units of material. Okay, the new price is calculated each time new materials are received and not at the time when there is a new issue. So just calculate at the times of receive. At the time of issue, you use the price that you calculated before. So advantages is less complicated than first in first out and last in first out. Okay, easier to compare cost between jobs because you take the average price. This advantage does not present actual buying price, not present actual buying price. Example, okay, 1st January 300 at 10, so equals 3000. Okay, 10 of January, another 200 at 11 is 2200. So your cost now is 5200. So weighted average cost is, okay, the total cost divided by number of unit. Total cost is 5200. Total unit is 500. So how much is your stock valuation now per unit? Okay, 5002 divided by 500, you get 10 ringgit and 40 cents. So this price actually is not the actual buying price. The actual buying price is 10 ringgit and 11 ringgit. So the price is fiction. Okay, so this is disadvantage of weighted average. Okay, so all the examples here, okay, we will see that we will record in the store ledger card. So the examples will be illustrate later. Okay, so now we move to store losses. So what is store losses? Store losses arise when the actual stock level is different from the store ledger account. So every stock movement you have to record in the store ledger account. Okay, and at the end of the period when you have stock take, that means you have to calculate the actual stock physically in the store. It may be different. So the difference between actual stock level that you calculate during stock take, okay, and the record in the store ledger card is store losses. Okay, store losses. Okay, the store ledger account must be adjusted. So where there is a difference, you have to adjust the store ledger accounts or store ledger card to reflect the actual stock that you calculated during stock take. So why there is a difference in the store ledger accounts and the actual stock when you have to do the actual stock count, physical stock count. So the reasons here may be because of made entry to wrong store's ledger account. So that means you record wrongly in the store ledger accounts, okay, or store ledger card. If the receipt, let's say if the receipt is 200, you record as 2000, let's say. Okay, the stock item is is placed in the wrong location, being placed in the wrong location. That means you put the stock in the different shelf. So when you make a stock count, okay, the amounts will not same with the recorded in the store ledger card. Okay, the third one will be arithmetical errors. That means the calculating in the store balance in the record. Okay, that means you do the error during calculate the balance store record or storage card. Or there may be a theft of stock. That means the record is correct, the physical stock count is correct, but there is a theft of stock. So that's why there is a difference between actual stock and also recorded. Or maybe losses during handling. Okay, during handling, maybe the stock breakage, stocks are breakage, damage, pilferage. Okay, pilferage. Or inherent stock storage costs such as evaporating, rusting, warping, wrapping, fading, or inefficient stores issues. So that means excess material issue are not returned to the store. That means when you issue to the production, when there is a extra or balance, they do not return back to the store. So it's mixed up with other unused items and being disposed. So that means your stock recorded being mixed up with unused item or the disposed item. Okay, so that's why your store ledger card recorded does not equals to uh, stock count. Okay, stock physical. So for issuance of material, okay, the material pricing issue. So this is the example that we have to go through. Okay, illustration for each of the example. First in, first out, last in, first out, and also with the average. Okay, so based on data for 6 months ended 31st December 2017, okay, there was opening balance 100 units at a value of 3,900. So it means that this material has in the store before this accounting period. That means you have before December, that means during November, you have the balance 100 units at the end of November. Okay, so opening balance for December at the value of 3,009. So during December, these are the transaction also, these are the stock movement. So bought quantity, that means the material is received into the store. That means coming into the store. Okay, on 5th of July. Okay, 14th of August, 28th of October. Okay, so we have units here and the price. So you can see the price is different for every date that you purchase. At the different date you purchase, the different price from the supplier. And then during the period, okay, you have September 22nd, you so that means take out from store, issue from store. November also issue from store, December also issue from store. When you have to prepare the store ledger card, you have to record according to the date. Okay, so the date is opening balances. Okay, 6 month ended. So 6 months we start from 1st July. Opening balance will be 1st July. Okay, 1st July, so this is the balance in the store. Then 5th July, you record, and then 14th August. Then we have to record 23rd of September. So how to record and to determine the closing stock value, and when we have a store loss 80 units, we refer to the videos for each of the methods.